So we can start discussing what is the new approach under pillar one of the expected global solution to address the tax challenges of the digitalization and now globalization as well. So I hope you can see my screen. What is all of this about? So as you may know, current international standards are not efficient enough in order to address what has been conceived the problem posed by the digitalized economy. So jurisdictions are now allocated with taxing rights on profits generated by business activities, depending on the existence of a permanent establishment through which the multinational enterprise derives the income. So in the absence of a permanent establishment, jurisdictions where activities are performed or income is paid out of is not in a situation where a taxing right can be exercised because of the tax treaty network that that jurisdiction may have enforced and prevent that jurisdiction from taxing business profits in the absence of a permanent establishment. That's the standard which is in Article 7 of both the UN and OECD model. So in the absence of physical presence, no taxation at source. So the problem is multinationals are now able to access markets, remote markets, without needing any foot on the ground. So business activities are taking place in a digital way without creating or without trespassing the threshold for taxation being granted to market jurisdiction. Pillar one is now trying to address this, trying to reallocate taxing rights to market jurisdictions where profits are generated in the absence of fiscal presence. How is it expected to be undertaken? That's something that has been discussed under Pillar 1 of the global solution proposed 2 years ago by the OECD Secretariat and explored by 139 jurisdictions expected to work in an equal footing. So under Pillar 1, there is an amount A, which is designed to allocate taxing rights to market jurisdictions with regard specific multinationals that will be subject to that taxation in the market jurisdiction, but not on the entire profitability, just on what is called non-routine profits. So now, if we stand on the current standard, there is taxation on zero profits. According to amount A, it is expected to be taxation just on non-routine profits. Non-routine profits are considered to be those that are derived in excess to what is considered to be routine profits, which are those that, according to current standards, are remunerating different elements in align with the arm's length principle. Those elements are functions performed, assets involved, and risk assumed in the business activities. So if there is profits, or if there are profits that does not remunerate any of those elements according to the transfer pricing analysis, those are the extraordinary profits, the non-routine profits that are targeted by amount A. In order to avoid complex analysis on what are the non-routine profits for a specific business activity, amount A introduces a simplification saying that for sake of simplicity, administrability, and to reduce excessive burden on taxpayer to determine the tax base, there is a kind of convention saying that routine profits will be deemed to be a specific portion of the total profits. So such portion has not been decided yet, We have heard 10 days ago that G7 suggested that the profitability margin out of which Pillar 1 will provide a taxing right for market jurisdiction will be 10%. But that has not been decided yet. Hopefully, a decision is taken in 2 weeks' time, favorable or against that, but a decision is expected to be taken. So let's assume by now that 10% will be the margin out of which any payment or any profit in excess of that will be considered to be non-routine profits and subject to the new allocation of taxing rights. So now, what is the portion of the non-routine profits that will be subject to tax in market jurisdiction? That's the reallocation percentage. We have also heard from G7 that they favor at least 20% of the non-routine profits to be taxed in market jurisdictions, while, however, most developing countries have favored a higher percentage, at least 30%, and why not 50% of the non-routine profits. So this is another issue for a solution. Let's hope that the inclusive framework is able to decide on this as well, taking into account that the higher the portion of the pie is shared among jurisdictions, higher collection will be, and more activities could be supported by that, helping and contributing to resource mobilization. So that's something to take into account for developing countries where resource mobilization is an important issue, and the 2030 agenda is claiming for. So now, after that tax-based determination, it is useful to say that single jurisdiction will be allowed to tax that portion of the pie if it meets the nexus requirement. It has not been decided yet, but it is expected that the revenues derived by the MNE from that jurisdiction has to be at least 1 million to be decided, but it's more or less the common idea, while allowing the least developed jurisdictions to apply a lower threshold around 250 euro per year. But that's something to be explored. It will depend on the GDP of that jurisdiction in order to see whether the 250,000 euros could be applied, or it has to apply the general nexus threshold of 1 million euros every year. So if it meets the requirement, then it can tax a portion of the non-routine profits, depending on the proportion of the sales of that particular MNE in that particular jurisdiction in comparison with the entire sales around the globe. So it's a kind of formulary apportionment that is expected to apply here. Now, to make it clear what we are talking about, we see here a green bar. That's the entire profitability of a particular MNE. From that, we can take that only a portion of this would be considered to be routine. So the yellow part is the non-routine and the one subject to taxation in market jurisdiction, but not all the yellow portion of the profits, but just a portion of that. That's the reallocable portion, the 20, 30, 50, whatever is agreed by the inclusive framework, but only that will be shared with market jurisdictions in order to exercise any tax on that. So I hope it's been clear enough on what is the profit allocation that is expected through Amount A and Pillar 1 in order to reestablish the international tax system in order to address the tax challenges of the digitalized economy. Just to sum up, I would like to share with you some views expressed by some developing countries among the inclusive framework members. If amount A is expected to increase the tax base and to provide an equitable tax treatment, so developing countries have been interested in order to achieve that, to have a change in the current proposal, or at least to have a consideration that at a low threshold of global revenue to determine the M&Es that are in scope will favor that aim. So it's not been decided yet, but the scope is an important issue. It will determine how many M&Es will be subject to amount A. So the tax base is directly linked with that, because the higher the number of M&Es participate in this kind of taxing exercise, so the higher the collection would be, and the more resource mobilization could be also achieved. It's not been decided, but according to a proposal, it is expected to be around 20 billion euros per year, the global revenue, according to which the size of the M&E is decisive in order to see whether or not it will be subject to amount A. Remember that according to the blueprints, which has been published and open for comments by the international community in January, according to that, only the threshold was only 750 million euros per year, so much more lower than what is now on the table. So that's something that developing countries have been claiming for, to have a reduced threshold to determine M&Es that are in scope. Moving to the allocation of taxing rights, the profitability ratio has to be determined, and also developing countries favor a low profitability ratio in order to determine the non-routine profits that will be taxed in the market jurisdictions. Regarding the reallocation percentage, that which is now between 20 and 30, regarding views expressed by members of the inclusive framework, as it has been pointed out, C24 and ATAF have presented a proposal saying that the higher the reallocation percentage will be, the better for the developing countries, since a bigger portion of the pie will be shared among themselves. And finally, the threshold for gross revenues in market jurisdiction to determine the nexus has to be the lower as possible, in order to allow every single jurisdiction to have an entitlement to exercise the taxing right. So that's what has been expressed by developing countries at the inclusive framework meetings and any of their sub-organs, in particular the task force on digital economy. So now we need to take into account there is another solution, probably developed further today in this session by another panelist. But the UN proposal has a clear difference here. It does not only allocate a taxing right on the non-routine profits, but on the entire profits. So that's a main difference between these two suggested solutions, and happy to encourage all developing countries to analyze this and to understand what their position could be, how would be the impact for that particular jurisdiction in addressing this proposal and exercising the right it has to take a decision later this month in the inclusive framework, in order to see whether or not a consensus could be provided in order to propose a global solution that would address all the concerns expressed. Thank you so much for your time, and happy to answer any question you may have. Thank you.